In this video, we'll be covering Chapter 9, Payroll. We'll cover Learning Unit 2, Computing Payroll Deductions for Employees' Pay, as well as discussing employer responsibilities. First thing I want to discuss is what gross pay is versus net pay. In the previous learning objective, we discussed how to calculate gross pay. Gross pay being the total amount that an employee has earned. So I like to use the net example. So take a look at this net here. At the top, we have gross pay. Gross pay is the amount that you earned. For example, if you were working an hourly job and you worked 40 hours a week and you were paid $8 an hour, then your gross pay would be 40 times 8, $320. From your gross pay, you have to subtract deductions, which is what we'll discuss in this chapter. Those deductions get caught in the net and are paid to different people for health insurance or your taxes, things like that. So at the bottom of the net, after you've calculated your gross pay and you've calculated the deductions that are held back, the net pay is the actual amount that you bring home, whether it's direct deposit or a paycheck. So net pay is what you actually get in the bank, and it's less than gross pay. So this is a payroll register. It seems a little overwhelming, but we'll take it step by step here. Companies often record employee payroll information in a multi-column form like this called a payroll register. So we're going to be looking at Glow Company and Janet Wong. And we're going to start out by looking at this letter A, allowance and marital status. And you see this as M-2. Well, that is gotten when she fills out a form W-4. The W-4 is a form that she filled out when she was hired, and it states that she is married and that she claims an allowance of 2 exemptions. So if you look back, M is for married, 2 is her number of exemptions that she is claiming based off of this W-4. And you'll fill this W-4 out anytime you start a new job. You could also change your allowances. For example, when my daughter was born, I could change my total number of allowances to an additional number. So you can change this. This isn't something that's set in stone the entire time you're at a job. It can be changed. So looking back at the payroll register, we see column B says cumulative earnings. Before this week's paycheck, see, she gets paid on a weekly basis. Before this week's paycheck, her gross pay was $127,200. Column B tells you that her salary per week is $26.50. So column D tells you how much she earned this week. Her regular pay of $26.50. She did not have any overtime, so her gross pay is $26.50 this week. Gross at the top before any deductions, which is what is over here. So she has a gross pay of $26.50. So column E tells you her cumulative earnings to year to date after this week's pay. It's the column B, $127,200 plus her gross earnings of $26.50 gives you $129,850. So her year to date pay is $129,850. Next, we're going to look at FICA taxable earnings. SS is Social Security, MED is Medicare. So we've got to learn how to calculate these two numbers. As you see down here, Social Security is taxed at 6.2% on what's called a tax base of $128,400. Medicare is taxed at 1.45%, and there is no base on her Medicare taxes withheld. So, Social Security and Medicare are employee deductions. It's funded by FICA, the Federal Insurance Contribution Act. Required as separate reportings. You have to report Social Security and Medicare separately. Employees pay Social Security until they earn $128,400 in this example, and Medicare has no base. You pay 1.45% on all earnings. And this base number here is indexed every year for inflation. So $128,400 might have been the base in, say, 2018, but it has gone up since then. So you always have to double check your FICA base, your Social Security base every year. But the book wants you to use this as your base. So for example, how much Social Security and Medicare will Janet pay if she earns a weekly salary of $26.50 and she's earned $127,200 by the end of week 49? So it's wanting you to calculate her Social Security and Medicare using this paycheck. So she had earned $127,200. This week she earned $26.50. So salary taxable for Social Security. If we take the $127,200 and add the $26.50, we would be over the Social Security base. So you only pay Social Security tax up until the base. So her previous earnings were $127,200 and the base is $128,400. So she only has to pay Social Security on $1,200. So security tax on $1,200, $1,200 times 0.062, she pays $74.40 in Social Security tax. Medicare, remember, does not have a base. You pay Medicare on every dollar that you earn. So her wages this paycheck were $26.50 times 1.45%. She pays $38.43 in Medicare. Here's another example. Calculate Social Security and Medicare deductions for the following employee, assuming a tax rate of 6.2% with a base of $128,400 for Social Security and then tax of 1.45% for Medicare. Logan had earned $128,300 before pay this period. He got paid $3,000 this period. So what is his Social Security and what is his Medicare amounts? First, we need to determine how much is taxable for Social Security. Our base is $128,400. He had earned $128,300. So we only have to pay Social Security tax on that $100, $128,400 minus $128,300 times 0.062. He pays $6.20 in Social Security. Now, for Medicare, he pays 1.45% on his entire wages. Remember, no base. So $3,000 times 1.45%, he'll pay $43.50 in Medicare. So looking back at the payroll register, we've discussed A, B, C, D, E, F, and G, and H, and I. This is the taxable earnings column. This says, okay, Social Security, he only has to pay tax on $1,200. So this is the column, 1,200 times the 6.2 gives you the $74.40. Medicare is taxable in its entirety. So his Medicare taxable earnings is equal to his gross earnings of $26.50. So $26.50 times 1.45% gives you $38.43. So we've covered A through I. We're going to move on now to column J, federal income tax withheld. Federal income tax withheld is calculated using the percentage method. So these are some charts straight out of your book, table 9.1 and then a partial of 9.2. We want to look back at this payroll register. Janet Wong is paid weekly and she is married with 2 exemptions. Those are important for calculating her federal income tax using the percentage method. First, we have to look at the payroll period. How often is she paid? She's paid weekly. So one withholding allowance is $79.80. She has 2, so we're going to need to double that amount. Then we go down to table 9.2, and it says married person. If the amount of wages after subtracting withholding allowances is, then this is how you calculate it. So in our example, Janet Wong had gross wages this week of $26.50. She is paid weekly and she has 2 allowances. So we need to subtract $79.80 twice to determine her amount of wages to look up in the table. When you subtract it twice, you get $2,490.40, which falls into this category. What this says is that the wages are over $1,711, but not over $3,395. Then the amount to withhold is $171.36 plus an additional 22% of the amount of wages over $1,711. So let's take a look at this. Janet earns $26.50 for week 49. Married with 2 allowances, what is her federal income tax? So like I said, table 9.1, locate the weekly withholding for 1 allowance. Multiply this number times 2 since she claims 2 allowances. $79.80 times 2 is $159.60. Step 2, subtract step 1 from employee's pay, from her gross pay. So $26.50 less $159.60 gives you $2,490.40, like I said previously. Step 3, in the table, locate the table and compute the income tax. $24.90.40 is between $1,711 and $3,395. So the tax is $171.36 plus 22% of the excess over $1,711. So take this number from step 2, subtract $1,711 to find the excess over $1,711, which is $779.40. The tax is equal to $171.36 plus 22% of the excess, the $779.40. So $171.36 plus $171.47, she has withholdings of $342.83 for federal income tax withheld. And you'll see that, if I can get back, here in column J. K is state income tax. We don't really do a lot with that in this chapter because the state income tax rate is different for every state. In this example, the book uses a 6% state income tax. So the book takes her gross pay of $26.50, multiplies it times 6% to get her state income tax of $159. She also has $100 withheld each week for her health insurance. So that is another deduction. You may not have that every time, but in this example, she did. So her net pay, the amount that she would bring home in the form of her direct deposit or paycheck, is $1,935.34. Her gross earnings of $26.50, less her Social Security withheld, her Medicare withheld, her federal income tax withheld, her state income tax withheld, and her health insurance withheld. So remember, this gross number is at the top of your net. All of these numbers are your deductions that get caught in the net for the net pay at the bottom of $1,935.34. Next, employer's responsibilities. An employer must match the employee contribution from Medicare and Social Security. So employers have to pay the 6.2% and the 1.45% on the same wages that the employee does. So if you've already calculated the employee withholdings for Social Security and Medicare, the employer portion is the same. Employers also have to pay 2 taxes that employees do not. They're solely employer responsibilities. Those are FUTA and SUTA. FUTA is the Federal Unemployment Tax Act. SUTA is the State Unemployment Tax Act. Federal Unemployment Tax Act says that employers have to pay the federal government 6% tax on the first $7,000 an employee earns in a calendar year. Any wages in excess of $7,000 per worker are exempt wages and are not taxed for FUTA. In addition, the state also has SUTA. The current SUTA tax in many states is 5.4% on the first $7,000 an employer pays an employee. Some states offer a merit rating system that results in a lower SUTA rate for companies that have stable employment. On the flip side of that, states also charge companies with poor employment records a higher SUTA rate, so that companies are not having to pay unemployment as much on the same wages. You can take a credit against the 6.0 federal unemployment rate of up to 5.4%. So if you pay 5.4% SUTA, you're only going to end up paying 0.6% FUTA. If your SUTA rate is higher than 5.4, you cannot take anything more than 5.4 as a credit. So for example, assume a company has total wages of $20,000 and $4,000 of the wages are exempt from SUTA. What are the company's SUTA and FUTA taxes if the company's SUTA rate is 5.8% due to poor employment records? So this is telling you that wages for the period are $20,000, but $4,000 of those wages are exempt. You do not have to pay taxes on them. Those are wages that are paid to an employee who has already earned at least $7,000. So the wage base that we'll be calculating on is $16,000. $16,000 is how much we're going to pay FUTA and SUTA taxes on. For SUTA, it's $16,000 times the 5.8%, 0.058. We're going to pay $928. For FUTA, it's $16,000 times 0.006, or $96. We're taking that 6%, reducing it by the 5.4 SUTA rate credit to get 0.6% tax. Notice in this example, the SUTA rate was 5.8. We cannot take a credit of more than 5.4. So we're going to pay 5.8% on $16,000 for state unemployment and 0.6% on FUTA for federal unemployment. We're going to pay $96. And that is the end of Chapter 9.